Hi, good evening, everyone, and thank you for joining the call on a short notice. And the reason for keeping this ad hoc call, uh, was that the last few weeks have been extremely eventful uh, for the bond market, especially. So, if you have seen, the yields have moved up dramatically, if I may call it, right? And driven by a lot of fear in the market and no other factors. So, we thought it's a good time to come and talk about the rationale why the yields went up and what's our view going forward. At the same time, we also feel it's one of the you know few opportunities that you get in fixed income market to make money, and these are the times when we can capitalize on that opportunity. So, without taking much time, Paijat, over to you.
Yeah, thank you, Saurabh. And obviously, as Saurabh highlighted, that in the last 1.5 months, what we have seen is that the yields have gone up, and despite 100 basis rate cut happening, since the February policy after the governor joined in December. So we thought that this is a good opportunity or opportune time to explain that why it has happened and what looks going forward for whatever the factors which we are fearing about this tariff, whether it is going to have a very long term impact or it is just a short term disruption. So let's begin with that. I'll share a couple of slides that I have, which will make it quite simple to understand. Yeah, is it visible? Hello?
Yes, it is visible.
Yeah. Okay. So let's look at this chart of the movement in the government of India securities yield. So I have plotted it from the 14th of March basically till the August end. So if you notice that the first policy cut, the rate cut happened in the February meeting of 25 basis point, and then the second was in April, and then again it was in June. So if you look at, so we had 25 basis rate cut in February. After that, the yields had were around 6.70, and another 25 basis happened in April, and then when they met in on 6th of June, there was a jumbo rate cut and of 50 basis points. So total 100 basis point rate cut has happened from 6.5% to 5.5%. On 6th of June, not only that rate cut was happening, 50 basis, but also the MPC changed the stance. Basically, the stance got changed from accommodative to neutral. And they highlighted that going forward, the room for further monetary easing is limited, and the neutral stance means that rate can be hiked, can be kept same, or there can be easing off depending upon the incoming data. So obviously the markets got a little nervous after that, a little jittery, I would say, and yields remained same at the same levels for a some period of time, actually. So when they again when the MPC met in 6th of August, there the markets were building in that, looking at the inflation data that we had and the high frequency data on the growth numbers were showing that there could be some monetary easing going forward or in this policy. However, the MPC decided to keep the rates on hold, and they wanted to see the earlier rate cut transmission to happen. The policy rate cut normally, or the policy easing or monetary policy normally happens with a lag. So they wanted to see it getting transmitted in the economy. However, the markets realized that despite inflation being low, the last month it was 1.5, but still the MPC decided to keep the rates on hold, and for the next financial year, they have projected it to be at around 4.5, which is 50 bips higher than the RBI's midpoint, I would say, that is, which is at 4%. And there were various other factors which I'll just highlight that why it, the yields started to pick up. So if you see that the yields have actually had touched 6.2, then moved back to 660. This is a 10-year. So across the curve, the yields have moved up by 30 to 50 basis point, and typically so on the long end, which is the ultra long end, what we call is 30-year, 40-year, and 50-year bonds. Now, as I had highlighted, what were the factors which caused the uptick in yields? This is just, I have mentioned GSEC, but basically both the GSEC yield, the corporate bonds, and the other fixed income instruments. As I mentioned, RBI's wait and watch approach, despite lower inflation, and changing the stance from accommodative to neutral. So markets believe that this is the end of the rate cut cycle, or this is how people started to build in it. That was first factor. Second was the tariff which was announced, which was 25%, because markets were not prepared for this high tariff, because it was believed that some kind of a trade agreement would be signed, because we were the first one, India was the first one to meet the US administration, and talks were going on. So when it was announced that the tariff would be 25% on exports, plus another punitive tariff of 25 if we continue to buy oil from Russia. Obviously, 50% tariff effectively means there is embargo. So you cannot export because it's not feasible. So obviously it would have impact on the domestic economy. Your current account deficit would increase, exports would take a hit, and the likely impact on GDP, from the initial estimates says that anywhere from 0.3 to 0.5%. Some economists are building in even 1%. So these are just initial estimates. We do not have full numbers. Obviously, the market started anticipating that obviously to support the economy, there would be some fiscal support from the government, and there could be fiscal slippages. This means what? They can issue more bonds, the supply would increase. So obviously markets became further nervous, and long end bonds got sold off heavily. So from 690, I would say that it touched almost 7.4344%. So that's a huge jump when you have a duration of 12 to 13 years. That's substantial, uptick in the yield. Then another, I would say that announcement was there from the government, which was in order to improve domestic consumption, because when you are having the export slowdown, higher tariff, and other impacts, so how do you revive the domestic consumption? Obviously, this was in the making for a long time. GST measures came in because that GST rationalization was announced on the 15th of August by PM Modi. So obviously, again, when you are having a loss of revenue, and the supply of the government of India securities would increase, it would impact fiscal deficit. So markets became further nervous. There was further sell-off in the bond markets. And the last thing was that for the last 2 months, I would say, there has been a demand-supply mismatch, because a large part of the calendar which the government is going to issue in the first half was in the longer end, that is 10 years and above, 15-year, your 30-year, 40-year, and 50-year. Now, these were based on what we call is that on a discussion with the institutional investors, because normally, the RBI and ministry meet the institutional investors to gauge the demand and accordingly come out with the issuance calendar. But somehow, these institutional investors shied away from investing in long bonds, the 30, 40, 50 years. There could be two reasons. A, the amount of money which they were getting from the the premium, they were slightly less, or they were also little fearful that looking at the yields going up on a very on a week by week, so they wanted to wait. And the third was that some regulation changes they were looking at where they could invest more in the equity markets. So the overall impact, the factors which I just mentioned, actually there was a massive uptick in the yields. So just realize that you have 100 basis rate cut, but the yields have gone up by 50 basis on a very long end, and 30 to 50 basis across the curve. So obviously it's going to have a very damaging impact on the economy. So the factors which we believed, because now the yields are very attractive. So if you look at the yield curve, so right from I would say the overnight rates, which is somewhere around 530, 25 to 35 it trades, the overnight rates, and then you have a long bond at the 40 year or a 50 year at somewhere around 7.40. So just look at the yield curve steepness which we have, a substantial yield curve steepness. Now, with such an attractive yield, and looking at the various factors that we analyzed, in our assessment, the what are the factors which are going to support a cap on the upward movement of the yield? That going forward from here, what is the probability that yields are going to go up substantially from here? Another 50, 60, 100, what? So what we look at is that, given that the bearish factors, normally what happens, markets runs ahead of the time. So given the bearish factors for uptick in yields, a large portion of the worst case scenario has already been factored in. And there are factors which are, if you look at very, logically or with a lot of data, because these are based on data. So it tells us that the probability of rates going up substantially from at this point, the probability is lesser. Now, what are these? A, inflation. The CPI came at 1.55, and if you have noticed, the GDP data which came in for the first quarter at 7.8, and almost your nominal GDP, the deflator is somewhere around between 1 to 1.5%. So obviously your inflation is low in the domestic economy, and a large part of that inflation is coming from food, but that also doesn't look that it is going to change substantially going forward, or there could be substantial uptick in the inflation trajectory or expectations. Look at the real yield. Real yield is basically what I'm saying is that look at your inflation. So because the idea is that the earnings should beat the inflation. So if the inflation is at 4%, I'm just taking the midpoint, which is today it is much lower than 4%. So if you look at the middle point of 4% and just look at your 10-year yield, which is at 6.56. So you have almost 250 basis spread over there. If I take a 40-year bond, which is at 740, so 4% and 740. So the real yield is very attractive. And typically for a developing economy, a real yield of 150 basis points is more than enough, because we have a potential, we are looking at growth. The term spreads, as I mentioned, are at extreme. This is given by the data points that we have. We have plotted for the last almost 15 years, which says that this kind of term spread is on the extreme if you plot the data. So from 535 to 740. So obviously the probability that elevated term spread, this means what? I'm assuming my fiscal is going to be very weak, growth is going to be very high going forward, or I'm going to be in hyperinflation. None of these things are looking to happen in the near term. So obviously these term spreads typically over a period of time, because of the attractiveness of the yield tends to adjust on their own over a period of time. And the most important factor is that you have cut rates because you believe that economy needs support, because monetary policy has to be supporting the growth. But the markets, because of the factors which I just listed in the slide earlier, the markets have gone up, the yields have gone up. When that has happened, obviously what I have done, I have tightened the monetary policy because the transmission will not happen. When I have a 10-year at 660, obviously my lending rates should be much higher. So the banks have actually highlighted to RBI that they are not able to pass on the rate cuts because of the high GSEC yield, because of GSECs are risk-free yields basically. So definitely there would be some policy intervention and support by the RBI. That's what is very looks logical or possible from going forward. Sufficient system liquidity, because the CRR cut should start to kick in from September onwards, that 100 basis over a period of time from September to November. So that definitely what the policy measures are there, that systemic liquidity would remain sufficient. So it is not going to impact the transmission to productive sectors that is there. So some measures would definitely be there, and RBI is meeting the institutional investors, primary dealers, today and tomorrow to decide on course of action, where the bond markets actually take some comfort and rate transmission starts to happen. So this is a very attractive time for investors to come in the fixed income market, because your yields are very high, they are attractive, your real yield is very high, and the factors which I just mentioned appears to be that they are at the extreme, and worst case scenario has been built in. So when you invest now, what happens, or what kind of ballpark return one can generate? Let me share with you. These are just scenario analysis. These are I have just taken as an example to explain to you that what we could see. Just look at this scenario analysis. Now what I have done is that I have just plotted or given the various category of funds from the short end of the bond fund to the extreme long end, which is the gilt fund. And if you take the portfolios, so these are the general YTMs would be there in the market, what I have mentioned in the YTM column. Modified duration based on the what looks attractive, which the maturity of the portfolio, and assuming that I am not saying that rate cut would happen, nothing more like something like that. It's only that the various factors which I said would cap the upward movement in the yield, and if some measures come in, or the attractiveness people start buying, demand supply becomes balanced, what would happen is that the scenario analysis I have done is that I have taken equal probability that there could be 25 basis up move in the yields, or similarly there could be 25 basis down move in the yield. Now what would be your mark to market losses if you hold it for say year? So look at that. So basically what I'm trying to do is that I'm looking at what is the worst case scenario total holding period return one can generate. So if you add the YTM and the MTM losses or the gains, so my worst case scenario I have just given. So even where I'm holding a very long duration, which is almost 12 years in a gilt fund, my minimum return that I can generate is 4.33%, and it is an uptick down movement in the yield by 25 basis. The returns are in double digit. This is just an example. It can be even more, but what is where the markets are going to move today, the levels at which we are, the probability is that the yields may, or the the compression may happen both on the term spread and your credit spread would happen. So probability of making returns is much higher than actually losing, because you're not losing, only your drawdown is only total holding period return become closer to 4% in the longest end, and on the shortest end up, because because there the duration is less, which is closer to your 1 year FD rates. So that's how I thought this is an opportune time to explain how we see the markets going forward. Now look at another chart, which would give you a good picture that where the yields are. In this, what I have done is that I have plotted in orange the GSEC curve, that from the 1 year at 5.64 and going upward to 10 years. I have not taken up to 40 years. It is at 6.57. On the top, the blue line, the dark blue line, is the yield which is there on AAA rated PSU corporate bond today. So on the shorter end, at least 1 year, it is 6.61. If you go up to 10 year, it is 7.35. So the spread between a sovereign paper and a AAA rated PSU, which is a quasi sovereign, I would say, the spreads are extremely attractive. So even say for a 5-year paper, it is at 708, 6.29, 708, almost I would say that 75 basis spread, the credit spread. And if you look at what we have done is a 5-year average spread I have taken, which you have the middle line. So the average spread over the GSEC of the AAA corporate bond is the middle line. So you have substantial credit spread to, the compression can happen. So you make returns from two aspects. A, the term spread compresses. B, the credit spread compresses. And I'm not even talking about monetary action of rate cut happening going forward or not. Just based on that, if the rate cut happens, looking at the global scenario, one can make even much better return in the fixed income market as of today. Now let's see that how I can or we can link it to the, as I mentioned, the global scenario. Now, because everywhere there is a fear of tariff. Now this tariff is going to impact our economy, it's going to impact our exports, it's going to increase our fiscal deficit target numbers, it would be bad for the the bond market or even for the equity markets. So because the earnings would go down. Let's look at what exactly the tariff is and does it really help. So is it a short-term disruption or is it going to remain for a long period? Very simply, I have used economics to explain this. Now, do higher tariffs, which the US has embarked upon, necessarily result in positive trade balance, or they help reduce the trade deficit? Is there anything that it can happen the way it has been has done by the US? Now, simply put, what is a trade balance? It is equal to national savings minus investment. It's a very simple concept. It's your national savings minus investment, where national savings is a sum of private saving and the government's budget balance, it is basically your revenue minus government expenditure. I is your obviously investment. That is simply put. So if I go one step further, the trade balance is a mirror image of country's savings and investment decision. That is very simply put. So when a country saves more than it invests, where TB, which I have said that the excess saving flows abroad, resulting in a trade surplus for me. So if you look at China, they have a trade surplus. If you look at Japan, they have a trade surplus. Now, conversely, if it invests more than it saves, what would happen is that you will borrow the difference from the rest of the world. leading to a trade deficit. And this is exactly what US has been doing for the last 4 decades. So for the US, this trend, which is S minus I, has been negative for the last 4 decades. The country has invested more than it saved, and it has financed this gap with foreign capital. So a lot of money has been flowing into the US markets because their investments, and because of the strong financial and capital markets and institutions that they have. So the trade deficit has been the natural consequence of a national saving shortfall. So their savings is closer to 4%, something around that percentage there. So macroeconomic, even if I have correlated it with macroeconomic data, so that which gives me a very clear picture that it is not going to solve their problem. According to Bureau of Economic Analysis, since 1976, investment in US has averaged 21.7% of GDP, while national saving has lagged at just 19.1%. So their goods deficit, which is today at 4%, and it's 2.6%, which shows up in the this figure which I've just mentioned. 1% they have a surplus in services. That's why their goods deficit is 2.6%. So closer to 4% that it comes. So this is a basic fundamental of any trade deficit. So now, if I increase the tariff, what would happen? Let's understand. As I had mentioned, that US public savings have been negative for years, public savings, as persistent budget deficit drags down national savings. So because they have a fiscal deficit or budget deficit very high, so it was closer to 4% deficit. The fiscal deficit is closer to 7%. At the same time, household saving rates remains historically low. It is just 5% of disposable income, reflecting in a consumption-driven growth model that's little room for financial surpluses. So the US economy, 75% is consumption, 25% is investments. In India, it is just the opposite. So we have 75%, India is also the same, 75% consumption, 25% investment. China is the opposite, where consumption is less, 25 to 30%, investment is 70%. So now if the US continues to increase its tariff across, like it has put 50%, 25%, Brazil 50%, 19%, whatever. So first, if investment continues to outpace savings, whether due to low household savings, large fiscal deficit, or both. In fact, in the US, both are present. Then trade deficits are certain. You cannot avoid that. So the US may not be able to reduce imports without changing the underlying flows of capital. Second, even if tariffs succeed in reducing import, because what happens is that if I put tariff, the prices goes up. Obviously, I'll start to import less because my consumption may be impacted, because higher prices I will try to substitute with a lower end. So your import may reduce maybe over a short period of time. The only way to generate trade surplus would be to either increase saving or reduce investment. So either I increase my savings now or reduce investments. Now increasing savings obviously looks very, very challenging in the US. However, the US administration has not proposed such policies where they have said that they are going to increase the savings. There is no tax hike. So in fact, they have done a tax cut and pushed for more domestic investment. They have asked for more domestic investment by foreign investment. So they're asking more money or more capital to flow in. So they have asked, or the trade deal is that you are also going to invest 500 billion, like for Japan, they're saying that to invest more 500 billion in the US market. So what you are doing is that, as I mentioned earlier, I have to reduce that capital inflow, which is not going to happen. So the twin surpluses, which is a shrinking budget deficit and a shrinking trade deficit, is not possible or very difficult without either a sharp increase in household savings, which looks unlikely, or a collapse in investment. Neither outcome is likely or would either be desirable for the US. So, in such a scenario, tariff alone may not be able to solve a trade deficit that is deeply rooted in structural macroeconomic forces. So what would happen is that, yes, these factors may have short-term disruptions, but the market forces, actually push the policy makers to readjust their policies going forward. So what we understand, or it is in our assessment, these kind of disruptions cannot last for long. And on 16th and 17th of this month, the US Federal Reserve is meeting, and the probability of a rate cut is 91.2% of 25 basis. And on Friday, we have a jobs data, and very likely their job data is not going to be very favorable. So, in an economy where the impact of these high prices are going to be detrimental, the job losses would go up, and you're cutting rates and prices are going up, is not a desirable scenario. So market forces and macroeconomic cycles do readjust over a period of time. So what we expect is that, from the medium to long end, both the bond market and I would say the equity market would start, would give you a very handsome return if you remain invested for at least a year's time. So in our assessment, this is not the time to fear. This is not the time to remain in cash. Please remain invested if you are there, or invest more if you have a surplus, funds to, invest, because these are the times to make handsome return from the markets. So that's all, briefly about, the outlook on the fixed income markets. And this outlook would actually play out in other asset classes also, say for equity. And I'll just touch upon gold. If you have seen, gold prices have gone up substantially, multi-year high. Now what are the factors? Because two things have started to happen. Rate cut in the US, probably the economy may not be doing well, but the inflation may remain sticky in US. But because they have a dual mandate of price stability and employment also, so there would be rate cut. And the independence of a monetary policy authority, basically the US Federal Reserve, because time and again we have seen that, the US president or their, officials talking about, why they are not cutting rates. US Federal Reserve, they want to put their own people or their own, officials there, or put their own thoughts into that. So markets have become a little jittery. And as I mentioned in this, last two slides, the 10-year and 30-year there has gone up again. So 30 is at back to 5%. So obviously, markets are definitely much, they run ahead of the time. They know exactly what's happening or how the policy measures are going to lead. So definitely, it is a very good time for the investors to remain invested. So that's all about the market as of now. So I'll be happy to take any questions if you have. So, but please remember, when everybody is negative, that's a time to look at the markets in a very, very data-oriented basis, and remain invested, not to remain in cash, because markets turn around very, very quickly. So I would be happy to take any questions, and over to Saurabh or Harshad also, if you have some comments to make.
Thanks, Faizat. We have few questions. Can we take them?
Yeah, please.
Yeah. So, one question is that you showed the spread dollar chart between the GSEC corporate bond and the 5-year
Yeah,
median.
yeah, yeah.
So, in that chart, the question is that it seems like that the spread in the 3 to 5 year segment is higher.
Yes,
So, like, does a corporate bond fund will make more sense than gilt if the horizon is for 3 years plus?
yes. Because why I'm saying that, normally, if you want to remain for a year, because gilt, is extremely attractive. But if you want to remain for a longer period, 3 year, corporate bond definitely makes a lot of sense because your spreads are higher, and corporate bonds generally, give you a slightly higher return than the gilt fund over a long period of time. Because gilt fund normally, when the yield cut has happened, everything, the cycle is over. Your returns could be volatile. So, but gilt fund makes more sense for people who can't stomach volatility, who can remain invested for more than a year, because gilt fund will give you return like an equity.
And you spoke about gold. Do you still see next 1 year a good year for the gold at these levels?
Yes. Why? Because probability is yes. Why? Because we have data which tells us that earlier, I'm talking about the 70s, and the that time the total holding of gold by central banks was much higher than US Treasury. Then over a period of time, the holding of US Treasuries went up, and the holding of the gold by various central banks fell. Now, in the last 1.5 year, I would say, because of the economic sanctions by the West and typically by the US, the central banks are trying to diversify their risk. They don't want to put all their eggs in one basket. So today, the total holding of gold by central banks has again gone up compared to total holding of US Treasury. So we have noticed that even the RBI and China, these are the large holders of US Treasury, they have reduced their Treasury holding and increased their gold holdings. So based on the demand supply, and obviously, it is not a commodity which can be produced very quickly, it has to be mined. So demand would continue to outstrip the supply.
The
And
next,
recently also we saw that people are buying silver also.
the next question is on inflation.
Hmm.
Many economists have predicted the inflation for the next year to be between 4.5 to 5%.
Hmm.
What's our view on the same?
See, as of now, because it's iterative, because every data point which comes in. So today, as we project, we do not see or assess that, because any policy or any changes, even whether it is GST or revival in economy, it takes time to happen. Until then, what has happened is that the wage growth has been very anemic. So when the wage growth is anemic, obviously my consumption would take time to get into the system. So urban consumption is still weak, and that's why the government is trying to revive the through the GST, that the consumption comes back. It takes time. So as of now, for the next year, I'm not or assessing that would be 4.5 to 5. It should be somewhere between 4.5, which is still very very low compared to an economy which is growing. Say I'm just taking 7.8% in the last quarter. So when an economy which has a potential of 7.5%, and your inflation is 4.5, it is very very low inflation, I would say.
And globally, the yields have been going up for the market.
Hmm.
So, is that a reason also why it has impacted in India, or India is completely dependent on domestic?
Nay, the sentiment spreads across the curve, across the globe happens. So now globally, if you see, the yields have gone up. As I mentioned, in the US it has moved up. Reasons being, as I mentioned, their high fiscal deficit, and the central banks are reducing their treasury holdings, and the tax cut. Obviously, when you have a tax cut but revenue is not there, so you'll have to borrow more. So when they're borrowing more, obviously, the supply is more than people are buying, so yields have gone up. If you look at UK, the fiscal deficit is a big issue there. So that budget deficit, fiscal deficit is a big factor. Economy is not doing well. So when the economy is not doing well, so your nominal GDP would be lower, revenues would be lower, and you are borrowing more. So obviously the yields have gone up. If you look at France has political challenges. So obviously unstable kind of a thing, and their fiscal deficit is close to 6%, and we are at 4.4. So just imagine if you look at Japan. So they are hiking the rates, and in fact the demand for ultra long bonds has gone down there. So even the Bank of Japan, which is the debt is almost 200% of GDP. So obviously the debt is huge. So when that is there, obviously your bond yields goes up. In India, it is not that kind of a scenario in terms of fiscal deficit or in terms of the GDP. More of a short-term, I would say disruption because of tariff and your demand supply over a period of time, short period. So it is not as bad as in India, what it appears globally.
And the next question is, can one take a tactical call in gilt for a short period of 3 to 6 months?
Yes, but please, be ready for volatility on a day-to-day basis.
So which clearly indicates, Paijat, that you're looking the yield to come down in 3 to 6 months.
Yes, in fact, today itself has, because now people are realizing. See, a time comes in the market when everybody starts to see that it has reached extreme, and fortunately, we were earlier ones to see that it is moving towards extreme. So now everybody is talking that yields are very attractive.
And the next question is on the rate transmission.
Hmm.
The rate transmission has not happened. In fact, it is the other way around, both
Yes.
and the FT
Hmm.
side. So do you expect that to be changing in the near future? And how will RBI, what measures can RBI use to get both the rates down?
See, RBI, two things can be done. A, the demand supply, like the markets, the buyers are long and bonds are your institutions, basically the pension funds and the insurance companies and provident funds. And typically the mutual funds or the banks do not invest in that long bonds. A, some tweak from holding period, that HTM kind of thing from the banks. B, for the B, there could be tweak in the calendar itself, where the supply on the long end reduces and short end increases, or somewhere that kind of a tweaking happens, that it is more balanced out, so that demand supply balances out. Because the very short end, it's always there's a demand from the mutual fund or the banks or the corporates is there. So obviously RBI has called meeting today and tomorrow to discuss with primary dealers that what exactly they can be done, or with the banks. In fact, they have been meeting with the banks for the last week itself. So what measures can be taken to make this transmission happen? So definitely some kind of a measure would be there, because it is not in economy's interest to have this kind of tight heat.
Paijat, there's a question on multi-asset fund.
Hmm.
So it says that gold is all-time high,
Hmm.
and my client has got a long-term to invest money for
Hmm.
retirement purpose.
Hmm.
Is it a good product to get in 30
Hmm.
years with currently gold being high?
As I mentioned, gold, I still feel till this geopolitical issue continues, with more central banks buying, I think gold rally may continue. So that is what the possibility is. The other thing is that when this is just from the technical aspect, what I have noticed or I've seen, whenever the gold remains sideways for a long period, it has been around these levels for a long time, there is another leg of rally kind of thing I have noticed in the gold market. So from that perspective, I would say that still one can come in, but yes, Your total holding period return may be slightly lesser if you had come earlier, but still your returns would be quite attractive.
Okay. Thanks. Another question is that how is the fixed income portfolio positioned in the hybrid schemes like balance advantage, multi-asset, aggressive hybrid? How is the duration over there?
See, based on our view, which I just explained, in all our funds, we are slightly in line with median or higher than median. Like, multi-asset, we are much higher than the median. And balance advantage, we are also slightly high, and same in aggressive. So because this is what our view is on the fixed income, so obviously it reflects in the fixed income portfolio of hybrid schemes.
The next question is on the GDP estimates. What's our GDP estimates for this year and the next 3 years?
Next 3 years would be very challenging to project unless I have some few more data points. But this year, as I mentioned, a lot of people are become very negative on our GDP growth. 6%, slightly lower because this tariff. But as I mentioned, I do not see it, sustaining for a long period. And moreover, government is taking a lot of measures, GST, and your tax cut or tax rebate up to 12 lakhs. These things take time to actually reflect in the economy. And as I said, the tariff things may not go on for a long period of time. And as the trade minister has been saying that we may be able to close that trade deal by by November end or something. Some work is going on. And please look at the oil prices. So we typically we are not even looking at that because it's stable. So on Sunday the OPEC Plus has a meeting. They've decided to continue with their increased production, and India is going to get close to $4 to $5 barrel discount on oil by the Russia. We have continued to buy oil from the Russia. So a lot of work is going on, and if you have a I would say that tariff barrier across the globe, it hits the global economy, and it is in nobody's interest to have that. So things start to reverse. So I would say that 6.5 is where we are looking at this year, and slightly better than better next year, somewhere between 6.5 to 7 next year. That's how we are looking at it.
Okay, thanks, Paijat. We have covered all the questions, and
Yeah.
thank you everyone for your time. Uh,
Thank you.
just to sum it up, as a fund house, we think it's a fantastic opportunity to buy into bonds. The yields have moved up. They may not remain at this level for a long time. Eventually, our view is that in next 3 to 6 months, they will cool off and come down, right? And very rarely you get opportunities like this in the like bond market. And you can look at our products like corporate bond fund, gilt fund, take advantage of these yields coming down.
Correct.
Thank you, everyone.
Thank you. Thank you.